Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at POIT technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
You know, when we talk about the AI revolution, everyone is obsessed with the brains of the operation.
Right, the GPUs, the NVIDIA chips.
Exactly. The Blackwell chips, the LLMs, trillions of dollars are chasing that processing power. But there's this massive looming crisis happening behind the scenes.
Oh,
It's not a brain problem. It's a nervous system problem.
a nervous system problem. That sounds a little medical for a tech stock deep dive.
Yeah.
You mean how all these AI clusters actually talk to each other?
That's it exactly. It's a plumbing problem, really. Think about it. You can have the fastest supercomputer in the world, a literal Einstein in a box, but if you're connecting it all with, slow copper wires, the data just gets stuck.
A traffic jam.
A massive one. Data centers are literally running out of power trying to push data through old school copper. It is arguably the single biggest bottleneck in scaling AI right now. The brain is thinking faster than the nerves can carry the signal.
And that perfectly sets the stage for today. We're looking at a company, POIT Technologies, that claims to have the solution.
The fix.
Yeah, and this is a high-stakes situation. The stock's in a rocket this year. It surged over 40% year-to-date before, a recent dip.
And they just got a huge pile of cash.
A massive war chest, about $150 million. But, and this is where I get really skeptical, I look at the revenue line, and it's tiny. I mean, microscopic compared to their billion-dollar valuation.
It creates a fascinating tension, doesn't it? You've got this valuation based on the future and financials based on a very, very quiet past.
It really does. So our mission today is clear. We need to figure out if POIT Technologies is just an expensive science experiment that investors are, blindly throwing money at, or if this tech is the inevitable future of AI hardware.
That's the question. Is this the fix for the plumbing or just another pipe dream?
All right, let's strip this down. So what here? The core technology is something called the POIT Optical Interposer.
Sounds like Star Trek technobabble, I know.
It does. So what is an optical interposer and why should an investor care?
The simplest way to frame it is the semiconductorization of photonics.
Okay, that's still a mouthful. Let's break that down for somebody who doesn't have a PhD in physics.
Right. Fair enough. So let's step back. Think about how electronics were built back in the 50s.
Vacuum tubes, wires.
Yeah, vacuum tubes, individual resistors. People sat at benches soldering things together by hand. It was slow, expensive. The devices were huge. You couldn't build a smartphone that way.
To be the size of a building.
Then the silicon chip came along. Suddenly you could print millions of transistors on a single wafer. It changed the world. It gave us Moore's law.
Right. We stopped building by hand and started manufacturing at a tiny scale. It's why our phones are so powerful.
Precisely. But here's the crazy part. Photonics using light for data is still kind of stuck in that 1950s stage.
What do you mean?
Even today, if you buy a high-speed optical transceiver, inside that little box are tiny lasers and lenses that, well, they often have to be placed and aligned one by one.
Wait, seriously? In 2025, we're still manually aligning lasers?
In many cases, yeah. It's called active alignment. You turn the laser on, a robot wiggles it around until the light hits the lens just right, and then you glue it down. It's expensive, slow, and it doesn't scale.
Sounds like a manufacturing nightmare. So POIT's pitch is they just stop doing that.
Correct. POIT has figured out how to build these optical engines at wafer scale, just like computer chips. They use standard semiconductor manufacturing to integrate everything onto a single piece of silicon. No active alignment, no expensive robots.
They just print the light paths. So they're dragging light speed data from like a craft brewing era into the mass production era.
That is a great analogy. They're industrializing light, and the specs here are what matter. This tech allows for a 1.6 terabit, even 3.2 terabit speeds.
So it solves the bandwidth bottleneck.
It does. But the real holy grail, the thing that makes the CFOs at Amazon and Google pay attention, is the energy efficiency.
I saw a number in the notes, something like 40% energy savings. Is that real or just marketing fluff?
It appears to be real. I mean, it's based on the physics of it. When you get rid of copper resistance and move data with light, you save a ton of power.
And data centers are starving for power.
Exactly. They're looking at restarting nuclear plants just to feed AI. So a 40% power reduction isn't a luxury, it's a requirement.
Okay, that sounds great on paper, but is anyone actually buying this? Or is it just a cool prototype?
They have validation. They've got partnerships with major players like Mitsubishi Electric and Semtech.
Good names.
Huge. Semtech is working with them on 1.6 terabit receivers. Mitsubishi is a giant in the optical space. Their involvement suggests this actually works in the real world.
Okay, so the tech sounds revolutionary. The plumbing fix makes sense. But now I have to be the bad cop.
Yeah.
Because when I look at the financials, yikes,
Yeah.
it is terrifying.
I had a feeling you were going to bring up the income statement.
I have to. We're talking about a company with a market cap over $1 billion. But the trailing 12-month revenue, it's only about $762,000.
Thousands, not millions.
Thousands. That's less than a couple of good coffee shops. And their 2024 revenue actually dropped 91%.
It's a stark contrast. There's no sugarcoating that. If you're a value investor, you'd run.
And it gets worse. They're burning cash. Net losses are around $50.5 million. EPS is negative 63 cents. So, honestly, are we just paying a premium for hope here?
It's the right question. If you only look in the rearview mirror, it looks uninvestable. But markets are forward-looking. They price in what's going to happen.
So what signals are there that something's about to happen? Because that revenue number doesn't scream inflection point.
You have to look at the trend and the quality of that revenue. Look at the most recent quarter, Q3 2025. Revenue came in at nearly $298,000.
Still small, but it's up.
It is, but here's the number that really jumped out at me. Gross margins.
What about them?
They're hitting 100% gross margins on these early revenues.
100%. How is that even possible? You have to buy the silicon, pay for the lights?
It's possible because a lot of this early revenue is NRE, non-recurring engineering fees. Partners are basically paying POET to develop prototypes for them.
Ah, so the customer is funding the innovation.
Exactly. And that shows massive pricing power. It shows these companies are willing to pay just to get access. It suggests that once they scale to mass production, the margin profile could be incredible.
Okay, I see the logic. It proves demand, but you can't pay the bills with a percentage. You need cash. And they were burning it fast.
Which brings us to the biggest news, that $150 million registered direct offering.
Yeah, that pile of cash. Usually when a company dilutes, the stock gets crushed. It feels like desperation.
This changes the entire thesis. Before this, the bear case was simple. They'll run out of money before the tech gets adopted.
Bankruptcy risk.
It was real. No, that's off the table. Clean balance sheet, almost zero debt. That $150 million is a war chest. It funds their expansion into 2026.
So they bought themselves a runway to take off. They survived the valley of death.
Precisely. The survival risk is gone. Now it's purely an execution story.
And that takes us to the technicals. Because that money didn't come for free. It came from selling shares. Dilution. And the chart shows it.
It certainly does. Standard stock market physics. Issue more shares, each one is worth a little less.
Right. The stock took an immediate hit, dropped, what, 8 to 17%? Purely on that dilution fear, it's trading now between 650 and 726.
But you saw the volume during that drop.
I did. Volume spiked to over 8 million shares. And usually you'd think that's just panic selling. But this felt different.
It looks like a classic bullish divergence.
Break that down for us. Why is high volume on a drop bullish here?
Well, who bought that $150 million worth of stock? It wasn't retail investors on an app. It was institutional money. The smart money absorbed the entire offering.
So while the price dropped from the math of it all, institutional ownership actually went up. They used the dip to get in.
That's a key distinction. They didn't struggle to raise it. It was snapped up. And if you look at the options market, you saw unusually high call demand. Traders are betting on a bounce.
They see it as a discount window, not a sell signal. And the stock is holding above its 50-day and 200-day moving averages. So as long as it holds support near, say, 633, the uptrend is technically intact. It bent, but it didn't break.
And that stability is crucial. It gives the market time to digest the new share count before the next leg up.
Okay, so we have the tech, the cash, and a chart that suggests big players are accumulating. But what's driving the excitement? Let's talk sentiment, because this is where it gets juicy.
All right, this is where we connect some dots. Have you heard of Celestial AI?
The name rings a bell. They've been in the news.
They're a big player in optical interconnects. Well, Marvell, the massive $70 billion chip company, just acquired Celestial AI for over $3 billion.
Wow. Okay, so good for Celestial, but what's that got to do with Poety?
Here's the kicker. Celestial AI's photonic fabric, their core tech. It's built on Poety's platform.
Wait, really? Is that confirmed?
The industry consensus and supply chain checks strongly suggest it. The designs align perfectly. The implication is massive. Marvell, by acquiring Celestial, has essentially validated POIT's technology.
That puts POIT right inside a Tier 1 supply chain, and that explains the rumor mill. Is POIT the next takeover target?
That's the speculation. Is Marvell going to buy them to own the whole stack, or will they just be a critical supplier? Either way, it moves POIT from science project to critical infrastructure.
And it's not just rumors. They're winning hardware awards, right?
They are. Their Teralite product won the Product Innovation Award. I love seeing this because it means the hardware is real. It's not a PowerPoint. It's winning awards against competitors who've been doing this for decades.
What are the analysts saying? Because Wall Street usually hates companies with no revenue.
It's a mix, but it's shifting. You have some short-term targets around 583, which is near where we are now. That's the conservative show-me-the-money view.
Fair enough.
But then you have long-term base cases that go as high as $34 to $45 by 2032.
$45? That's a 6 or 7x from here. That's massive.
That's the potential of this market. The consensus is shifting to buy based on an expected revenue explosion in 2026. They're looking past the current valley.
But we have to be responsible. Let's talk about the bear case. Why could this all go wrong?
Well, you already hit the big one, dilution.
Yeah, I have to hammer that again. They issued about 20.7 million new shares. Every existing shareholder's slice of the pie just gets smaller.
It's the cost of doing business.
Right.
But the real risk is, what if they burn through this $150 million without hitting high-volume production?
If they miss the window.
Exactly. If we get to 2027 and they're still tinkering, they might have to dilute again. And at that point, investors lose patience.
And scaling is hard,
Yeah.
right? Building 10 chips in a lab is one thing. Building 1 million in a factory in Malaysia is something else entirely.
That's the execution risk. It's a complex challenge. Yields can be low, supply chains can break, and they have missed earnings estimates before. Q3 missed by 37%. They don't have a perfect track record.
Good point. Trust needs to be earned.
Mm.
And then there's the valuation itself.
The premium for hope?
The company trades at a price to book about 13.7 times. The industry averages around 4.7. That's a huge premium.
It means the stock is priced for perfection. Any delay, even a 6-month delay in that 2026 ramp, could crash the stock price. You're paying up front for success that hasn't happened.
So this is not a value stock. This is high-octane growth.
Precisely. You don't put your rent money in this.
All right, we've covered the tech, cash, charts, rumors, risks. Time for the verdict. What's the investment thesis?
First, the timeline. If you're looking to make a quick buck next week, this isn't for you.
This isn't a day trade.
No. This is a play on the second half of 2026. H2 2026. That's when the Malaysia factory is supposed to come online and start spitting out revenue.
So we have some waiting to do. What are we watching in the meantime?
The catalysts. You've got the OFC conference, the big optical networking event.
Mhm.
Watch for demos there. Then you have the Sivers semiconductors prototypes in the first half of 2026. Those are the checkpoints.
Okay, so if I'm watching those dates like a hawk. Let's put a number on it. Bullish score.
I'm giving this an 8 out of 10.
An 8. That's high, given the lack of revenue we just talked about.
It is. But that $150 million changed the math for me. It takes existential risk off the table. Before the cash, it was a 4 or 5.
Interesting. With the runway secured, I'd say I made a 7 or an 8 as well.
So we're aligned. My final thesis is this. POIT has built the toll road for AI light speed.
The toll road.
Data centers have no choice. They need the 40% energy savings. The physics demands it. And now that they have the cash, this becomes a must-own speculative play on the AI infrastructure boom. It's a call option on the future of computing.
I agree. For me, it's about asymmetric reward. Yes, it's high risk. The stock could get cut in half if they fail in Malaysia. But if that plan scales, if they become the standard, the current revenue is irrelevant. The dilution was just the price of admission to the big leagues.
You're betting on the inevitable shift from electrons to photons.
And that brings me to a final thought for everyone listening.
What's that?
Think about the S-curve. In tech, adoption starts slow, it looks flat. That's where we are with optical computing. We're at the very bottom of that exponential curve. And usually, the biggest rewards go to the people who position themselves before the curve goes vertical.
That's a powerful way to look at it.
Thanks for joining us on Smart Wealth with Joshua.
Don't forget to subscribe and smash that like button. We'll see you in the next one.